There's more agents than there are existing deals on market right now. So with the changes that are happening, AI, with sales getting harder, brokers, commissions, all those things changing, how are you setting yourself apart in this market as an agent?
What we quickly wanted to do is differentiate ourselves right off the bat, because what we didn't want to see is ourselves blending in with the crowd.
I call myself a professional Band-Aid ripper in my job, because everyone comes and they want to build an ADU, and I have to tell them the actual cost of it.
What I'm seeing is a lot of individuals that jumped into this without the understanding of the multifamily space are losing their ass.
So what are some of the mistakes you've seen in this bonus ADU program?
I see very aggressive performance, and these performas are killing deals. These ADU developers are either doing it on their own and they're losing their money, or they're doing it with other people's money, these aggressive performas, and they're losing their investors' money. You have $1 million property, and you're making, after all fees, expenses, taxes, and deferred maintenance, you're making like $30,000 a year.
Moving forward over the next 5-10 years, who are the people that really win in the investment space?
It's a great question.
We all get the same 24 hours. So why is it that some people build so much more with them? I'm Brian Coons, and this is the Builder Nation podcast, where we talk to top performers, entrepreneurs, and visionaries to uncover the architecture of a meaningful and fulfilling life. Let's get into it.
Welcome back to another episode of the Builder Nation podcast. Got my boy Joseph Silva, who is a 7-year investment banker, business banker turned real estate strategist for investments, for really leading people towards the right type of strategy for the real estate market. You've been, all over the place, and there's a lot of agents out there. There's more agents than there are existing deals on market right now. So with the changes that are happening, AI, with sales getting harder, brokers, commissions, all those things changing, how are you setting yourself apart in this market as an agent?
It's a great question. I think differentiating yourself from the marketplace is important. And I think, to take it back, what we quickly realized whenever we started our brokerage was we started out as a team before we brokered out. We were doing just sales, primarily in the single family home area sector of real estate. And we were working with everyone, whether they were investors or whether they were buying their first home. And what we uncovered pretty quickly was everyone's doing that same thing. Just like you said, there's more agents than there are properties to sell. So what differentiates you from the guy next to you? I don't know what the statistic is now. I haven't looked at it in a while, but I think it's like 1 out of every 6 or 7 people that you meet has a license. I feel like nowadays I'm only meeting people that have licenses. Everyone has a license. So what differentiates you from that other person? And what we quickly wanted to do is differentiate ourselves right off the bat, because what we didn't want to see is ourselves blending in with the crowd. And what we did very quickly was we kind of analyzed our clients, and, what clients have we seen the most success with? What clients have we, built deeper relationships with? What clients have we brought the most value to? And because of my background, as well as my business partner, Armand, his background's in, investments primarily, as he worked with Marcus and Millichap. He's done it all in the real estate realm, and he has a background or knowledge set that I don't think most real estate agents have. And with my background in investment banking as well as business banking, I quickly realized the people that we can honestly bring the most value to are the investors. So then from that lens alone, it's all right, so how do we bring more value than the other guy, right? How do we look at this from a different lens? What are people doing? And then we started networking and just simply asking the question, how are you serving your clients? And what we quickly found is not many people are doing much, many things different. And what we quickly were trying to figure out is, well, what could we do? Because we're kind of stepping into uncharted territory here. It's a path that's commonly walked is, investment real estate, just like every other agent's doing the same thing. So how do we kind of get off of this path and differentiate ourselves even more so? And so we created CCG, and quickly that turned into learning how to evaluate real estate, multifamily real estate specifically. We decided to stick with multifamily and ADU developers. They're pretty much the same. They're in the same field. And figure out how the buyers were analyzing assets, and then be able to communicate to sellers how those buyers would be looking at assets to help them understand how to evaluate their assets, and then how to move their money amongst other real estate. How is your real estate performing? Let's start there. And let's figure out what your goals are. I want to define where your goals are. Are you early on in your investing career and you're looking at being aggressive and growing your portfolio for what reason? And then let's talk about what you currently have, and let's figure out how we can improve that. And then if that's not you, if you are on the latter half of your investing career, let's say you've been active your entire life, you expand your portfolio beyond your dreams, and you have all these single family assets, you're looking at getting a little bit more passive or closer to retirement with less headaches. Let's talk about what your options are. Let's talk about how I can help you get to what your goal is, which is, I think, unique because most real estate agents today or they see themselves as salesmen more so than they see them as as advisors. So what we did was we don't even use the term real estate agent anymore. We have a real estate license and we do get paid on the brokerage side. We don't charge for consultations or portfolio analyses. We charge like other brokers do on the buy and sell of every other transaction. However, we lead with value. And we lead with value because what we hope is basically whether or not you're deciding to sell today or deciding to sell next year, we just hope that we have earned because we brought enough value to the table on the forefront and not try to push you in any other one direction. We brought enough value on the forefront that whenever the time does come, when the decision is to be made, we have at least earned a seat at the table. And that alone, I think, grows. It creates this rapport that most people can feel. Like people can sense where our hearts are. And I think that's a huge part of it is like making sure you're coming from the right place. Like you're truly seeking to serve. And how do you serve? Well, I seek to educate. I seek to understand. And then with their permission, I seek to help and guide. And I don't know if that answers, but I think that kind of gives you an idea of what we do.
There's so much gold in that, man. Like from the perspective of, I want to start with, it's what really, I think, sets people apart in this industry right now is the fact that you have a unique background for a certain subgroup of people buying homes. And so for me, anyone who wants to do the ADU thing or the real estate development thing, that's where I can help and add value, right? It's like you have a very unique background and experience in investment banking and business banking, and you can take that, and those people who will get the value from that unique skill set are the ones that are going to go to you. You're not going to be the right fit for everyone, even though you have the same license that allows you to buy and sell real estate. Sally and Tom, who are, moving into their forever home at the age of 29, like that's probably not your subgroup, but that's okay because somebody else can serve them because they have unique experience. But that was probably one of the best things that most people getting this could probably do is gain a specific unique skill set as they're growing, continue to make themselves more and more unique.
That's really good. I think to add to that is you have to be very clear on what your skill sets are, and then be very clear on who you can serve to your highest capacity with those skill sets. And then once you define your ideal client, and that takes time, it takes filtering. You have to create a really great filter. I can't help everyone. I can, right? Like I can help people buy their first home. I can help people sell their home, move into the next home. I can do all those things, and I can do it pretty well because I have a process and the experience to do so. But by doing that, I'm removing myself from the other clients that really need my help. Like there's certain clients that I can help at a higher caliber and bring more value to than I can these other individuals. Although I can do that just as well as anyone else. It's a more saturated market and it's harder to differentiate yourself. I like to go through the filtration process of like, whenever I'm meeting a new client, I am very well just as much. I'm interviewing my clients just as much as they are interviewing me. I want to make sure that they are the ideal client that I seek to serve and I seek to help and I seek to work with, right? There's a lot of clients out there that I can help, but I don't want to because the headaches that come with it aren't worth it.
Yeah.
Ultimately. So to synthesize that a little bit, again, I'm interviewing my clients just like they are interviewing me. I want to make sure that they are the ideal client for us, so that we know that we can bring the most amount of value to the table because our reputation's everything.
Yeah. No, that's huge. And that it's so funny you say that because I think that's one of the biggest differentiators between a newbie salesperson and someone who's been in the space for a long time is you don't just take every client that can freaking find your name on the internet. You look for, at that point, it's like, a bad client is going to cost you 10 times as much time. It's going to cost you more money than it's worth, more headache, more stress, and not allow you to then go get the good client. So being able to filter through I remember at the last company that I worked at, that was essentially all I did was talk to people and bring on projects. And I remember so many people where I was like, fuck no, absolutely not. Like they're like, absolutely not. Like there's another company that'll help them out. or they're just never even going to do anything. And I would like just, give them like some value, give them some value, tell them exactly what they could do on their lot and just like send them on their merry way. And that it's so funny that you say that, because I think that really is one of the differentiating factors between, a good salesman or I don't want to say a good salesman, but a good leader in the space versus one that isn't as good, is you have to kind of apply to work with them in a way. Like they don't just work with everyone.
I think you said something there. When you're getting into the space, you have to work with everyone. You have to you got to put your money where your mouth is. You got to go out there and help everyone as much as you can to at least get the experience that you need to better understand who you are and what kind of person that you're trying to be and who you're trying to help. Like you have to go help as many people as possible. And like through the process of actually helping as many people as possible, you very quickly kind of, you're able to, at least as I see it, you're able to quickly filter like with the mistakes, by falling on your face, by helping the wrong people, by jumping into the wrong transactions. You're able to further hone in your ideal clientele.
Yeah. Well, that's really huge. And I'm thinking about that and I'm like, that goes for like any industry. It doesn't matter if it's freaking an agent. It doesn't matter if I'm thinking about social media, right? Somebody in our mastermind group just asked today, he's like, hey, I'm having an issue like putting out content because I just can't think of more good content. And it's one of those things where like when you're in the beginning of something, whether it be software, social media, agency, whatever job, it's like you don't know anything yet in terms of who that ideal client is. You don't know who you're going to vibe with. You don't know what things you're going to like to niche down on. And so you're saying like, go in and just be a sponge, interact with people. Like they'll self-filter. You'll get some learning lessons, but the more you work with people, the harder you work in that front stage, the more quickly you're going to get to the point where you now have found the people you don't want to work with. You've now found the things that you aren't interested in. You've now found the ways that you can add the most value, and you're going to get that market feedback like pretty quickly. And I think that that's something that a lot of people, they try and start with the solution, right? It doesn't matter, software or whatever. They try and think, there's this issue in the market, so I'm going to do this thing to solve it. Or I'm going to be the ADU guy, or I'm going to be the house hack guy, like whatever it is. They don't know, like maybe you don't have the background and story that really aligns with those people. And you would actually make a ton more money and be able to add a ton more value in another way. And so like, that's something, and that's not something you know until you start getting that feedback. You're like, why didn't that person close? I thought we were like, vibing or whatever. And you get feedback. It's like, yeah, I just went with somebody else. I'm like, oh, it's because I'm too young or like whatever it is. Right.
Mm-hmm. Start broad, start as broad as possible, talk about as much as you can and educate yourself. And then as you seek to educate yourself, seek to share that knowledge with others. And whenever you start to get the feedback that you're looking for, the eyes, the attention, whenever you start to see that, then you start to hone in on either, if it's of interest to you to continue to talk about those things, you go continue to talk about those things, you create more content on those things, then you perhaps create a solution for that thing. And you capitalize on that market if you're able to communicate to that niche. But yeah, you start broad and you hone in according to who you are as a person, what the people out there like, and what the market needs.
Yep. Yeah. And another thing, and then, I want to hear your opinion on it, but it's like most people who are in consultative sales roles, and that's really what it is. It's consultative sales. You're selling, but you're not selling because you're just consulting them. And then they're saying, holy shit, you're the person, like, why wouldn't go with anyone else? Like, you've given me so much value. You're clearly an expert on the space. And that's, I think, one of the best ways that you can do it. So it's like most of the time, it's more just marketing to get in front of the people than it is sales at that point.
I think Alex Ramosi is the one that said this. I heard it's kind of changed my mindset about a lot of things. He was like, seek to solve a small problem for people for which leads to a larger problem or reveals a larger problem that you can capitalize on. So as we're talking about consultative sales, what I seek to do is help to educate people on how they're doing in the real estate portfolio. Because more often than not, if you've been in real estate long enough, you understand people don't get second opinions on their portfolios. People don't have other people look at their real estate and say, this is how you're doing. Here's where room for improvement is. I seek to get people to open up to me, to share what they have, to show me what's underneath the hood. And I can analyze it. I can tell them how they're doing. And then with that information, by me solving that solution, here's the assets that you own. Here's the Excel sheet for which analyzes what your return on equity is, what your cash on cash is, how you're performing. Here's what the market is trading at. This is how if you were to sell this and you were to exchange it into a newer asset, this is what this looks like. I uncovered the small problem, which is I define how they're doing, and then they tell me what they want to do with that information. And that is where that's where I make money. And I don't seek to, I don't want to help I've told more people not to sell than I've told them to sell. And that's just honesty, and people respect that. And again, that's with the heart of bringing value up front, not trying to steer their direction, tell them honestly how I feel, what my knowledge, what I feel is correct for them to do, as if they're my own parents, my own grandparents. And then when the time does come that something needs to change, they come back to me and they're like, hey, you were honest with me before, I'm going to be honest with you now. Yep. This is what we're thinking. What are your thoughts on it?
Yeah. I call myself a professional Band-Aid ripper in my job, because everyone comes and they want to, build an ADU, and I'd have to tell them the actual cost of it or the risk of going with the cheap guy. And it's funny because that's, one of the best things is like the transparency of like, look, dude, like you probably shouldn't sell this right now. Like it's cash flowing fine, whatever. Like that's going to hold, because most people do. They're like, oh, like here's what you could get right now in the market. So like, you could put that into something else right now and you're good. And instead of saying like, no, like, I would probably hold off on this one maybe do something too. And that's where I think these other things where it's like, you're not just the buy sell guy. You're the ADU, you're the add value, you're the, hey, that makes sense to 1031 this one right now, roll it into something. So that's like, I want to talk about that a little bit of like, what is the real playbook behind looking at someone's portfolio and identifying what to do and what not to do depending on the market?
The key metric that we use is return on equity. So to step back a little bit, we have two really like buckets of clients. We have the active and we have the passive. We have the active investors that are looking at growing their portfolios, the ones that are, early on our age, got their first 2, 3, 4 properties and then looking at expanding it. And they want to better understand how they can do so, how they can leverage these properties to buy some. Does it make sense to do that? Or does it make sense to take out more debt? Or does it make sense to sell these assets and roll that into the next property? There's a bunch of different strategies to do so. ADU is just another strategy of that. Buying multifamily that are underperforming, buy them at a good cap rate and then sell them at a better cap rate. That's one like niche set of clients that we have, is the active early on investors, the hungry, the risk takers, the one willing to go out there and get their hands dirty. Then a large portion of our clientele, majority of our clientele, are actually the older generations, the ones that bought their first home, lived in it for a few years, made some money, leveraged that home and the appreciation to buy their next home, moved out of it, rented it, bought the next one, and continued to do that over decades. And they've acquired 5 to 15 to 20 single family homes, maybe a multifamily here and there. And they've held these assets for 20 to 30 years. And they own these and they're trying to become passive, but they really are active. They're managing these 20 properties on their own by themselves, or they have a property manager that's doing a piss poor job more often than not, right? Let's be honest. Most are very lazy property managers, and they allow rents to get super low. And then they have these assets that they own outright. There's zero leverage on them, and their depreciation schedule is completely exhausted. So they no longer have any tax benefits from the real estate portfolio. And they're looking at these assets and they're like, listen, and cash flow is important to us. They're like, tax situation's not ideal. They're looking at us and they're like, I have too many assets. I have too many freaking tax things going on here. I don't want to deal with this anymore. How do I get from here to simplicity? Like, how do I sell this without paying Uncle Sam and continue to invest in real estate? And then we educate them on what a 1031 exchange is. Sometimes they've done 1, they've done 2, they went well, they went bad, they didn't go as well. They have some scars working with other agents. They don't know how to analyze their assets from an investor's lens. They don't know how to evaluate their properties. And we basically come to the table and we ask them about their assets. We evaluate each asset. We're like, all right, here's how you're doing. Here's your return on equity. You don't have any debt on these assets. Here's how your money's working for you without leverage. Here's your returns, with your low tax basis. Usually their tax basis is extremely low. They don't want to forfeit that. That's always a hurdle for them. It's like, I don't want to, my property I'm getting taxed on is like $100,000, but the property's worth $2 million. Why would I let that go, Joe? Why would I go take on new debt when debt's at 6.5%? And then, after we share these numbers with them, they're like, okay, that's helpful. Great. I knew that. Now what? Well, it's like, depends on what you want to do. Do you want to be more hands-off? Do you want to be more passive? What does that look like? Well, there's a couple assets that you can sell these and exchange into without having to pay capital gains. And we talk through all those buckets. And we're like, you can move this into a TIC. You can move this into a DST. You can move this into a commercial asset. You can move this into direct ownership, whether that's another single family home or multifamily. And as we seek to educate them and better understand what really matters to them, they're like, well, why would I do that and forfeit these things? How would my cash flow improve? Well, sometimes, more often than not, whenever you own an asset and you've held it for all these years and you don't have the tax benefits, you no longer have leverage, and the value of the property is significantly increased like we've seen in the last 5 years, but their rents have not increased at the same kind of cap. It's like, here's what your return on equity is, and it's usually sub 3%. You have $1 million property, and you're making, after all fees, expenses, taxes, and deferred maintenance, you're making like $30,000 a year. Like, how does that make you feel? You can go move this, you can sell this asset, and if you had $1 million, you put it into a risk-free asset like a treasury, you're getting 4.5%, 5%. You're making more money by owning treasury.
Yep.
But you don't own a risk-free asset. You own a property with a tenant in it.
Yep.
There's risk there. Well, I don't want to forfeit this low tax basis. Well, you're going to have to if you want to change something. So we educate them like, all right, well, here's the equity you have for this property. Let's start with one. If you were to sell this and you were to buy another property of similar size, your returns in today's market, if you're buying a stabilized asset, one that has been as stabilized as you understand, but for the audience, it's one that's doing as well as it could be given today's market. All right, the rents are where they're supposed to be. If you're buying a multifamily asset, more often than not, you're buying a 5 cap. That's what we're looking at right now in today's market. You're buying at a 5 cap. If somebody's marketing for less than that, it's not going to move. If you're buying at a 5 cap, you're getting 50%. You're getting 5% on that $1 million, which is $50,000. And on top of that, you're getting a new tax schedule or a depreciation schedule. And if you decided you want to take out some debt and leverage up a little bit, then you get those benefits that are related to the interest for which you aren't paying. Your tenants are paying for you. And it's this educational approach to like educating these, like to consulting these individuals that haven't had a second opinion and helping them understand that they're not stuck where they're at. They have options. Problem more often than not is they have too many options. They don't know enough about any of them to make a wise decision to step forward. And we are the people, the men, the group, the company, the brokerage with the information. It's just a matter of helping them understand that we're here to provide you that information to show you what your options are. And when you do make that decision, we're here to help you.
Hey guys, if you're a business owner, high income earner, or investor who's been thinking about getting into real estate development but don't have the time to manage the process, this is for you. My company partners with people like you to help unlock the potential of your properties or even source and manage new small scale development projects. We manage hundreds of ADUs and infill development projects across Southern California, and our team knows how to simplify the process so you can benefit from the upside without managing contractors, permits, or design headaches. Whether you want to develop your own property, explore ways to offset taxes, or just learn how the development model works, head to thebuildernation.com/partner. That's thebuildernation.com/partner, and see how we can help you build more with the same 24 hours. Now back to the show.
That portfolio, you explained a very specific demographic, which is really important. You're like, yeah, it's the 5 to 15 unit person who's picked up properties. They're generally in the older crowd. They've had it for a long time. They have a lot of equity and they just, kind of been sitting on them. I think that's, a super helpful place to start with somebody is like as you get further and further down, you can really start to see, it almost these questions start to repeat themselves, or these answers kind of start to repeat themselves. And then you're saying it's like, well, what's your risk tolerance? What's your, your 5-year plan and strategy for it. And so where do you think most of that demographic, if somebody's sitting on several properties with a good amount of equity, they're getting towards the older generation and they don't know what to do with them, what generally tends to be the right answer for them in the Southern California market?
It's unique to each client, to be honest.
Yeah. What are some of those ways?
If you own 5 single family homes and you're tired of dealing with 5 different roofs and 5 different sets of sewer lines and 5 different selling multiple single family assets to exchange it to one larger multifamily is a great option for many different ways. Why it matters to them is specific to those clients. And we would only advise that if that was of their interest. If they have more interest in being completely passive, they're looking at, they still want direct ownership, but they want mailbox money. The closest thing to that with direct ownership is a triple net lease. So some individuals, I've helped somebody sell a industrial property up in the Central Coast. He basically lived at this property. He was there day in and day out dealing with BS, just nonstop. And his return on equity was like 1.5%. It's like sub 2% is ridiculous. And we're like, I know you'd love this property, but like, how much do you love this property? Like, are you at the point in your life where you want to be retired? And that's what you're telling me, but you're saying you don't want to sell. How are you expecting to be able to retire with this property? Are your kids going to want to own this property? What are your kids going to want to do if, something happens to you, God forbid, and you own this asset and it's in the trust and they got to take it over? What are they going to do? What would they want to hold? And for that individual he wants mailbox money, but he still wants direct ownership. We helped him sell his asset that was doing, 2% or less return on equity basis and move that money into a triple net lease, which was a Dollar General back east. And he's doing 6.5% on his money. We tripled his income overnight by selling the asset. And now he doesn't have to worry about that. He doesn't have to worry about those tenants. He doesn't have to worry about those repairs. He doesn't have to worry about the headaches that came with that industrial property. And for him, that made the most sense. Now we have other clients that are like, I don't want any of those things. I want a DST or I want a tenant-in-common. I'm not a fan of DSTs personally, full transparency. The one asset that you can exchange into that has the highest fees related to it, more often than not. And honestly, it's more of a, like, people move money into DSTs, or they should be moving money into DSTs if they truly are, like, as I understand it, they have extra cash in their exchange that they have to place somewhere. So let's move it into a DST to shelter it so you don't have to pay taxes on it and still get a return on it. Who cares about the fees? And then there's also tenant-in-commons, which is you're basically investing in, let's say, a 500 unit multifamily in Arizona. And this guy, the general partner, purchases an asset and then they're looking for money. They're looking for LPs, and you're an LP basically. You believe in the investment thesis, you believe in the operator, and you place money into this 500 unit. There's usually a lockup period, but there's, like, assuming that their track record's good and their returns are favorable and you believe in the investment thesis, you place your money in that and they give you a check monthly or quarterly. So to answer your question more directly, it's like, for some clients, it is more direct ownership, just larger assets with new depreciation schedules, better cash flow. Some other clients, it's checks in the mail. And, it's largely, again, determined by their goals and their profile, their risk tolerance.
Yeah. No, it makes sense.
And their heirs. Their heirs are just as important.
Yeah.
They think about their heirs when they're making these decisions at that stage of their life.
Right. That's really important too, is that, generally the older people get, the less risk tolerant they become, because they, just towards the tail end of things with just the young and hungry-ness of them. So a lot of these people, right? A lot of these people have probably been sitting on these properties for 10, 20, 30 years. All these, especially in Southern California, a lot of these things have changed in terms of, like, ADUs and things like that. So where does the ADU thing kind of play into that strategy now with you guys?
Great question. I wanted to get into this because I got questions for you too, if you're okay.
Dude,
with
let's
that.
run it, bro.
I'm seeing the ADU space blow up. I'm a firm believer that the ADU space in San Diego is, like, the greatest opportunity for any hungry investors, right? They're not easy. Don't get me wrong. They were a little bit easier back whenever people were cowboying it and just pushing things through during COVID. They've changed. Regulations have become a little bit more firm. They're not allowing you to throw 20 ADUs in the backyard anymore. There's limits. The zoning's super important, more so than it was. There's a lot of great things that are happening, but what I'm seeing is a lot of individuals that jumped into this without the understanding of the multifamily space are losing their ass. If you buy a single family house and you put 8 ADUs in the backyard, you're no longer going to be selling a single family house. You're going to be selling a multifamily asset, and you need to very firmly understand how those assets are looked at by the investors and what type of client would be buying that. Because that type of asset is not for everyone.
Yeah, so what are some of the mistakes you've seen in this bonus ADU program?
Very, very, very aggressive formas. Here's a great example. I got clients that are running these ADU programs or running these ADU development deals right now that are giving me their pro forma, and they're giving me they're like, talking about selling these things. And they're like, yeah, this, we're getting pretty close to lease up, getting our COC or our CO. And they're like, we're pretty close to lease up and we're looking at taking this to market. What do you think it's worth? And we'll give them a valuation. And they're like, no, you're completely off. You don't know what you're talking about. I was like, okay, why? And they'll be like, oh, here, because this is what the income's going to be. I'm like, no, it's not. You don't have any parking. That's okay. These assets don't either. Okay. Well, show me those assets. Show me your comps. Show me what you're looking at as an actual comp for a rental in this area for a 1-bedroom, 1-bath. And they're showing me multifamily assets, large, like, institutional quality multifamily assets, for which have some parking. More often, North Park specifically, they don't really have too much parking anymore, but they're fully amenitized. They have gyms. They have
Pools.
like pools. They have amenities for which you don't have as an ADU developer or on this project that you're building. You don't have those amenities and you cannot use those as comps. You cannot. My first answer to your question is, where do I see holes? I see very aggressive performance. And these performas are killing deals. And these ADU developers are either doing it on their own and they're losing their money, or they're doing it with other people's money, these aggressive performas, and they're losing their investors' money. And they're trying to sell these assets and they won't work with us because we're telling them what their property is going to sell for or what the market's going to allow it to sell for, what the market's going to deem its worth. And they're telling me what theirs is. And there's a $200,000, $300,000, $400,000, $500,000 delta between the two. And they don't want to allow me to take their property to market at what it's worth. So they go to the market and they sit there.
It's so funny. I felt the passion in that and just the experience behind that. And I have a very similar experience when I was, getting into the space, and I was part of it, right? Like I was new to the space, and the question was, how many units can you put? And then there was no thought process to the amenities that are included and how that affects rent. Somebody says, "Oh, I saw one studio over there rent out for top dollar, so all mine are going to rent out right there." And you're explaining like you're a Band-Aid ripper. You're the guy who comes in. You're like, dude, maybe something happens, right? Like I'll eat my shorts, right? Or I'll whatever. But it's like I've been in this space a long time now, and nothing's selling there. Nothing's going to sell. Like here's why. Here's this reason. Here's this reason. And yeah, unfortunately, I think a lot of people they aren't ready to hear that. I don't say they don't want to hear it, but they aren't ready to hear it yet. And it's something that, the market will dictate what value is. I'm having a conversation right now with one of my buddies, and he has a project that has, had some issues on and some snags along the way. And we were looking at value, and I, was underwriting where my value was at. And then we were just really thinking about all these other strategies and ways to like, maybe if we sell to like the homeowner instead and we fix up the back, and we're looking in like every scenario, whether he puts more money into the property, he doesn't, he sells it as is, he sells to a developer. The value was pretty much the same, like at net at the end of the day in every scenario. And I was like, holy shit, like the market kind of like it really will dictate. Like it's really, I mean, I'm 100% like on the same page of there was a lot of people who have never been developers yet doing big boy developer things. And they've had a lot of learning lessons. And I think that you touched on it. One of the biggest issues that I've seen is just when you're not doing it with your own money, or you're doing it with other people's money from the perspective of, hey, I'm the developer, I'm the expert, not, hey, like, let's figure this out together. Like, this is my first project. This is your first project. Let's go figure it out, put some money in and get the battle scars.
You might be an expert developer, but that does not mean you're an expert multifamily investor.
Yeah.
Truly need to understand before you build the product, who the end buyer is going to be, who's the tenant that's going to live in this unit. Right? That's important.
Sure.
What's the parking situation going to be like? Is that going to be a problem? Is the parking going to be absorbed in this neighborhood? Those are important factors to look at. If nobody can park on the street, nobody's going to rent here. I don't care how close they are to a transit station. Like, I don't care if there's a bus. I don't jump on a bus. Many people aren't jumping on buses. Unless they can walk to work, they're not going to forfeit a parking spot. Now, if the rent is cheap enough, they might. Now, if you're what I'm seeing is like a $200 delta in pro forma versus actual rents is huge.
Yeah. So how much do you think not having parking affects a multifamily property?
It largely is determined by the neighborhood it's in. It has to do with whether or not the actual neighborhood could absorb it. If you're sitting next to 3 other ADUs in the same neighborhood or in a cul-de-sac, right, there's not going to be parking for 10 tenants. Okay, you're adding 7 bedrooms. There's going to be at least 7 vehicles going in that neighborhood. Can you drive down that road at night, during the morning, midday, and find 7 parking spots? Look at that. That's important. Other piece of, I think, what's really important is understanding what the buyer profile is going to be for this type of asset. I think there's a lot of developers. There's quite a few I can think of right now. We're not going to name drop that are developing these, and their intent is not to sell. And that's pretty smart. That makes sense. More often than not, if they're able to develop these ADU complexes, these multifamily assets under ADU laws, and they're able to hold on to it at the end and not have to sell it. Financing's tough right now. You got to know somebody. Know a guy that knows a guy. You need to know somebody that's going to be able to finance these deals on the back end. You have to. But if you have confidence that you're going to be able to finance this and still cash flow, that's a great option. But make sure you have multiple strategies. Like whenever you're going into a deal, don't put yourself in a position where you have to sell. Like if that's your only exit strategy, you're going to fall on your face. A lot of things are going to go wrong. Timelines are never what they're projected to be. Costs are never what they're projected to be. Have a very conservative assumption on how this is going to look and jump into it, working with somebody, analyzing it with somebody that knows what they're doing. You might be, again, an expert developer, but that does not mean you're an expert multifamily investor. You need to understand how the multifamily investors are going to be looking at this asset. You need to understand what the buyer profile is going to be. Those clients I was talking about that are nearing a retirement, they want a hands-free asset. Well, if they're going to buy a multifamily asset, are they going to buy one that's, built in 1970, or would they prefer to buy something that's stabilized, that has no deferred maintenance, that's built in 2024? They're going to be a great buyer for you. What are they going to think about no parking in this neighborhood, this location? What are they going to deem this property to be worth? That's what you need to understand. Who is going to be the buyer, and what kind of cap rate delta is there going to be between a parked asset and a non-parked asset?
So how much per unit in rent do you think gets discounted for not having the parking in a half decent area?
I mean, there's no shortage of rentals in the market right now without parking. A couple $100. I can tell you that the delta between, a parked asset versus a non-parked asset is at least 1/4%, if not 0.5%, which is huge.
Yeah, I mean, you multiply that depending on how many units you have, that's millions of dollars in some scenarios.
I mean, let's look at some quick math real quick. If you have somebody that's underwriting a property, let's call it a 10 unit for easy numbers. It's a 10 unit multifamily ADU development. 10 units. And they're assuming $2,500 per unit. That's $25,000 a month. $25,000 a month times 12. Let's assume a 30% expense ratio. Okay, 30% expense ratio. So times 0.7, you have 210,000, or 210,000 of income, net operating income, roughly per year. Is divide that, but what the going cap rate is for parked asset, 5.25. All right, you're looking at a $4 million asset. Okay. You have a $4 million asset, assuming you can get $2,500. Now let's assume there's a hole in your assumptions on rent. So let's assume that let's not make an assumption, but the reality is people that were developing 3 years ago that are just coming to fruition today, there's probably going to be a $200 delta per month per unit.
Because they've assumed 3% rent growth the whole time, probably.
They probably have. And assuming rent growth is not a good bet. All right, so there's a $200 delta between what pro forma was, what actuals are. What does that look like on a 10-unit structure? Now you lost $2,000 of income a month. Times 12, times the same assumption of 30% expenses, divided by 0.0525, $3.68 million. Your valuation, because you lost $200 per unit, has just dropped almost $400,000. That's a huge delta for people. That's a huge delta.
That's
you just made
profit.
$400 less because your pro forma was too aggressive.
And that's what I think a lot of people miss too, is like, that is the developer's money. That is the delta that the developer makes on the deal. So when you're raising money, the first people to get their money back are the people that have been in the deal and invested in it with you and put the money in. And the issue there is most of the time, they're going to get their money back in most of these scenarios. Most people, as long as they get it to the finish line, are adding enough value to actually execute and sell the project and get their capital back. But when they're selling it, it's like, you're going to make 3x your money in 2 years because we're going to build this thing. That's where people are going to get burned, is like, it's the opportunity cost is a huge thing that I think people are going to lose out on.
Huge. Yeah, there's so many holes and a lot of people got burned, are getting burned. A lot of these assets that people started developing 3 years ago, bought 3 years ago, started developing a year and a half ago, or come to fruition. They're just trying to go through the lease-up process, and these are just hitting the market. You're not the only one. I know we're kind of like being the bearer of bad news for people here, but there's still opportunity out there. There's still great opportunity. My point is here that I'm trying to just really hone in on is you have to know what you're doing, and you have to be conservative on your assumptions, and you need to have more than one exit strategy. You have to.
I think you just hit it, right? And that's kind of like where I want to take this question is like moving forward. Like, I mean, I see it, I'm in it all day long, day in and day out. Like, yeah, you just have to be conservative when you're looking, you're underwriting and getting other experts' opinions. Every single deal I have, I ask Austin Huffman. He's one of the best brokers I freaking know in San Diego to give me valuations, rents. I ask property managers. I have the individual experts of the individual pieces evaluate and help me fully evaluate a deal from start to finish. It's not.
That's such a great point. That's something that I think a lot of people don't understand is that just because you have access to Zillow and Rentometer, all these other apps, doesn't mean you know what the going rate is in these areas. If it's on the market, if the rental has been on the market for 40 days, it's probably not what the rental market is. You shouldn't be using that assumption or that property as what your pro forma is going to say. If you are looking for the most accurate pro formas, you're not going to just look at Zillow. You're not just going to look at Rentometer. You're not just going to look at non-amenitized assets. You're going to look to the individuals that are the experts of those markets. If you're going to build a ADU development for student housing, don't just call it a typical leasing agent, call it a student housing leasing agent. If you're going to build something in North Park, don't call just any general property manager in the area. Call that like the guy in that area that's property managing assets there, because they know the nuances, and there's more nuances than you even realize. And I realize, and I don't even try to act like I know. I have to go and call these people. If people are coming to me for my advice, my guidance, I'm going to give them the best I can. And the best I can is not the information that I have. I'm an expert in some areas, but I'm not an expert in every area. And I have no problem calling the experts and asking the question.
Dude, that's such a valuable statement is like, and I say this all the time, is like, I don't pretend to be the expert in everything, but I know who to call to ask the question to get the right answer.
We have the humility to call them. Some people don't. They think they know everything.
Yeah.
They want to act like they do.
It's hard. I have a buddy who they're moving to San Diego from another state, but they have an agent who's licensed in California, and they're using him, and they're sending me a couple deals to look at to like house hack. And I'm like, dude, like what? Absolutely not. That is an awful area. And it's like, it's San Diego to the guy. And it goes back to just like the expertise in something, the hyper localness to something, whatever. It could be an area, or it could be a niche, or it could be whatever. But it's like, yeah, like you're saying, I think the humility is the biggest part is being able to say like, dude, like I'm not the end all be. I can get pretty close on rents, but like I'm going to call him and like validate this before I give you like the final answer. So I think that's huge, man. But so to kind of close this out, moving forward over the next 5-10 years, who are the people that really win in the investment space?
It's a great question. I can't tell you exactly who's going to win, but I can tell you the asset that I'm most confident in today is multifamily.
Why is that?
People in this area are not renters because they want to be. They're renters by necessity, and that trend is not changing. The cost of living has not gone down, and I don't expect it to go down here. The cost of living is going up. You can't buy a house making $100,000 a year. You can't buy a house here in San Diego making $150,000 a year. People have to rent. They're always going to need a place to live. And if you're looking at placing your money in assets right now that have more certainty, I would say multifamily is the best bet. Knowing how to invest in multifamily, knowing the location is very important. Define if you're looking for cash flow, San Diego is not the area. There's areas of San Diego that offer greater cash flow, but you're ultimately not buying cash flow whenever you buy in San Diego. You're buying appreciation, and appreciation outruns cash flow. Like, I think it was Thatch that said it. He was like, appreciation outruns cash flow like a Ferrari does a Fiat. If that's what you're trying to go for, which is appreciation, wealth creation, you're looking at assets in this area. I would be looking at multifamily. Rent growth's great. Valuations of single family, like appreciation of single family is fantastic, but multifamily is next best in my opinion. Office has been killed. Industry is, manufacturing, as they say, is, a kiss of death. I personally, I don't know enough about every asset to be able to tell you that, this person's going to win, this person's not. Hospitality is a great type of asset to go after. If you're looking at boutique hotels, a lot of opportunity out there. I think there's opportunities in every single asset class in real estate. It's just a matter of, do you have the right investment thesis? Like, what is your investment thesis? And do you have confidence in that? Going to withstand time, the next 5 years. I think conservatively looking at multifamily, in my opinion, is the greatest place to place your money, especially if you're in the, latter half of your life and you're not looking at doing too much. There's a lot of stabilized assets that are, ADUs right now that are you're selling at a 5 cap, 5.5 cap, possibly. Well, if interest rates start to go down, which they will at some point, cap rates will start to go down as well. They'll compress. And whenever they compress, the valuations of those multifamily assets go up. Interest rates right now are high and they're ugly. But if you're buying an asset at a higher cap rate, whenever interest rates go down, the cap rates compress, you're creating some massive value. I'm a huge fan of multifamily. That's my answer. I think multifamily investors they're gonna do well.
Dude, that's awesome, man. If people have a portfolio, people want to get in touch with you, have you help out with it, what's the best way to get in contact?
Me directly. Instagram's Life of J Silva. First name's Joseph, last name's Silva. J Silva, Life of J Silva. Or my business is CCG Real Estate Advisors. We work in not just San Diego County, but up and down key coastal California markets. CCG is Coastal California Group. So if you have any questions, feel free to reach out to me and I'd be happy to advise.
Dude, appreciate you coming on, man.
Appreciate you having me.
That's it for this episode of the Build a Nation podcast. If it gave you something to think about, hit subscribe, leave a review, and share it with someone who's leveling up. Until next time, keep building.